If you've been around markets long enough, you know the biggest moves usually don't start with the names everyone's already arguing about on social media. They start quietly, while the story still sounds too early, the charts look too ugly, and the headlines don't feel urgent yet. And then one day, a single catalyst hits an approval, a contract, a margin inflection, a policy shift, and suddenly the same stock that couldn't get a whisper becomes the one people claim they always loved. So here's the game we're playing today. 5 under-the-radar stocks, trading around $10 or less. 5 hidden $10 gems that, if the right dominoes fall, could see an outsized re-rating into 2026. Quick reality check before we begin. Nothing in this video is financial advice, and Set to Explode is about potential, not promises. These are higher risk, high volatility names, and you should only ever put real money into the market. If you've done your own research and you're comfortable with losses, if you're under 18, loop in a parent or guardian before making any investing decisions, because learning is awesome, but rushing is expensive. With that said, let's get into the 5 tickers, the hidden catalysts most people are missing, and the exact watch for this, signals that could tell you the move is actually happening, not just being hyped. First up, Archer Aviation, ticker ACHR, the air taxi play that most people still treat like sci-fi, even though the groundwork for real-world trials is being pushed right now. As of today, December 21, 2025, Archer is trading around $8.16 a share. The core idea is simple. Short urban trips that are painfully slow by car become quick hops by electric, vertical takeoff, and landing aircraft EVTOL. The part that's not simple is certification, safety, and building a system that regulators, cities, and passengers actually trust. That's exactly why the next 12 to 18 months matter. Archer has been positioning itself for U.S. air taxi trials tied to a broader national push to get advanced air mobility out of PowerPoint and into actual skies. Their own investor updates in mid-December 2025 highlight trial planning under a White House executive order context alongside a U.S. Department of Transportation National AAM strategy rollout. Here's what that means in plain English. If the government is actively standardizing how these programs work, it lowers chaos and speeds up the okay, show us the aircraft phase. Then there's the international angle Archer, signed an agreement in Saudi Arabia tied to scaling eVTOL deployment, which matters because global partners can fund infrastructure, offer pilot programs, and create headline moments that keep momentum alive even if U.S. timelines slip. Now, let's talk about what could make a CHR explode by 2026. It's not just that air taxis are cool. It's that the market loves a story that goes from no revenue dream to real operations pathway. When a company goes from concept to manufacturing plans, to certification milestones, to trial routes, investors often reprice the entire business because the probability of success changes. The watchlist signals here are very specific. Announcements that tighten, certification timelines, clearer trial, city details, and evidence of production readiness that feels believable, not aspirational. The risk is also very specific. Certification delays, cost overruns, or a market mood swing that punishes anything speculative. In other words, ACHR isn't a buy and forget. It's a watch the milestones like a hawk stock beat, because milestones are the whole valuation. Second, Aurora Innovation, ticker AU, Aurora Autonomous Trucking. One of the most underrated AI in the real-world categories because it's not a chatbot. It's a 40-ton machine on public roads. As of today, AUR is around $4.16 a share. Here's the hidden truth. If autonomous passenger cars are the flashy dream, autonomous freight is the boring business that actually might scale first, because trucking routes can be more structured, more repetitive, and easier to control operationally. Aurora's recent updates show tangible progress. They've talked about surpassing 100,000 driverless miles on public roads and validating additional commercial lanes, along with lowering cost hardware and integrations aimed at broader deployment. And then you get the kind of announcement that matters more than hype. A commercial agreement where Detmar selected Aurora to deploy an expanded fleet of autonomous trucks for a major energy producer, including 24/7's highway operations moving frac sand in the Permian Basin. That's not just we tested a thing, that's we're being chosen for real, repetitive logistics where uptime and safety equal money. If you want the explode by 2026 thesis, it's this. Once a company proves a repeatable autonomous freight service lane, the conversation can flip from R&D burn to unit economics. And when markets smell unit economics, they start imagining scaling more lanes, more customers, higher utilization, better margins, and that's when small caps can move violently. The watchlist signals are expansion of commercial lanes, more contracts like Detmar, evidence they can run without the training wheels, and progress on the regulatory and safety narrative that unlocks broader adoption. The risks: a single high-profile incident could slow adoption, timelines can slip, and cash burn can punish shareholders. But if Aurora keeps stacking credible commercial milestones, the market doesn't need perfection, it needs proof that autonomy can be sold, not just demoed. Third, Navitas Semiconductor, ticker NVTS, one of those infrastructure quietly eating the world companies. As of today, NVTS is around $7.81 a share. Navitas is focused on next-gen power semiconductors, especially gallium nitride, or GaN, and silicon carbide. SiC materials that can improve efficiency and power density versus traditional silicon in many use cases. Why should anyone care? Because the world is in an energy efficiency arms race. AI data centers are exploding, power costs are a nightmare, and every percent of efficiency matters. The market loves the headline, AI winners. But the unsexy truth is that power delivery from the grid, through the data center, through the server power supply becomes a bottleneck. Companies that help reduce losses, improve charging speeds, or shrink power hardware can ride that wave. Now, NVTS is not a clean, easy story today. Their third quarter 2025 results showed revenue at $10.1 million, down year over year and down from the previous quarter, which tells you demand can be uneven and the company is still in the prove-it phase. And that's exactly why it can be a gem instead of a crowded trade. The market often hates the messy middle, right before adoption inflects. If NVTS starts showing signs of stabilization and growth, bigger design wins, improving revenue trends, clearer traction in higher value segments, then the valuation can change fast because investors are paying for future scale. The watchlist signals are tangible customer wins, revenue trends that stop sliding and start compounding, and commentary that suggests demand is broadening rather than concentrated. The risks are also real. Competition is fierce, execution matters, and small semiconductor companies can get punished brutally if adoption takes longer than expected. But if you want to buy 2026 Catalyst Framework, it's not about a single announcement, it's about a sequence. Efficiency demand increases, customer wins accumulate, and the market realizes this isn't a science project anymore. That's the re-rating moment. Fourth, ChargePoint, ticker CHPT, the EV charging network name people love to clown on, right up until turnarounds become undeniable. As of today, CHPT is around $7.32 a share. The reason this is interesting now is that the story has been quietly shifting from growth at any cost to discipline and survival, which is exactly what you want to see before a market starts rewarding a beaten-down company again. ChargePoint's third quarter fiscal year 2026 results reported in early December 2025 showed revenue grew 6% year over year to $106 million. Subscription revenue grew 15% to $42 million. Gross margins hitting record territory in their non-GAAP reporting, and a debt reduction of $172 million after quarter end. That's the kind of update that signals we're not just burning cash and hoping. And here's the hidden angle. Subscription revenue in a hardware-heavy business is the quality revenue. It's stickier, often higher margin, and it gives the market something to value beyond one-time station sales. If CHPT can keep subscription growing, keep margins improving, and keep the balance sheet from becoming a ticking time bomb, the market can re-rate it as a survivable platform instead of a doomed hardware vendor. The explode by 2026 scenario isn't that everyone suddenly loves EV charging again. It's that the company demonstrates a credible path to cash flow improvement while EV's adoption and infrastructure build-out keep grinding forward in the background. The watchlist signals are continued subscription growth, stable or improving margins, evidence that utilization and network economics are trending the right way, and any policy or fleet partnerships that drive demand. The risks: EV adoption can be cyclical, competition is intense, and if capital markets tighten, even improving companies can struggle. But CHPT is exactly the type of stock that can surprise to the upside if it crosses the line from maybe to measurably improving, because that line is where sentiment flips. Fifth, Ginkgo Bioworks, ticker DNA Synthetic Biology, Biosecurity, and the Wildcard Platform bet. As of today, DNA is around $8.10 a share. If you hear biotech platform and immediately think cash burn, you're not wrong to be cautious. Ginkgo's third quarter 2025 results showed cell engineering revenue of $29 million versus $75 million a year earlier, though the prior year period included a $45 million non-cash revenue item that makes the comparison messy, and biosecurity revenue of $9 million versus $14 million in the prior year quarter. That's not the kind of top-line chart that makes the average investor excited. So why is this here? Because the hidden story is optionality plus contracts. especially in biosecurity and government-adjacent work, where scale and recurring demand can show up in chunks. In early December 2025, reporting around Ginkgo noted selection for a multi-year contract with potential value up to $47 million tied to phenotyping work with a national lab context. And the company has also highlighted partnerships around tools for predicting drug safety, which signals continued positioning as an enabling layer rather than a single-product biotech. Here's the explode by 2026 logic. Markets often misprice platform companies when revenue is uneven and the story is hard to model. But if the platform starts stacking credible, paid deployments, especially in areas like biosecurity, where governance and large institutions fund the work, the valuation can move quickly because the will they survive. Question fades, and the how big can this get? Question takes over. The watchlist signals are meaningful contract wins, improving predictability of revenue, evidence that cost discipline is working, and continued traction in biosecurity pandemic response style work, where budgets can be large. The risks are huge. Platform stories can drag on, revenue can stay lumpy, and investors can lose patience. But that's exactly why the upside can be explosive, because if the narrative turns, it turns hard. Now zoom out for a second, because the real secret to these kinds of picks isn't the names, it's the pattern. All 5 of these stocks share a common setup. They sit at the intersection of big future demand and current skepticism. Archer and Aurora are trying to cross the pilot to product gap. Navitas is trying to ride an efficiency wave while proving adoption. ChargePoint is trying to complete the classic turnaround. Better margins, cleaner balance sheet, more recurring revenue. Ginkgo is trying to convert platform potential into repeatable contracts. And that's why they're under $10 right now. The market is charging them for uncertainty. Your job, if you're tracking these, isn't to fall in love with the story. It's to track the uncertainty and watch it shrink. Because price moves are basically the market adjusting probability. When the probability of success goes up, the valuation changes. When the probability goes down, the stock gets crushed. That's the deal. So here's how you use this video the smart way. Make a watch list. For each company, write down 3 milestone signals you want to see by mid-2026. For a CHER certification and trial clarity. For a UR, more commercial lanes and real contracts. For NVTS, customer wins and revenue stabilization. For CHPT, subscription growth, margin progress, and balance sheet discipline. For DNA, contract wins and improving predictability. And then, you don't get emotionally hijacked by daily price action, you check whether the milestones are happening. Because if the milestones hit, you'll often see the market reprice the stock before it looks safe. And if the milestones don't hit, you'll know early that the story is stalling, and you can step back. Let's close this out the right way. These are not sure things. They're bets on execution and timing. Any one of them can disappoint, dilute shareholders, or get derailed by macro conditions. But if you're looking for that classic small cap setup where a stock is still cheap, because most people don't believe yet this is the category. 5 hidden $10 and under names, 5 different industries, and 5 different catalysts that could snap into focus between now and 2026. If you want, I can also turn this into a tighter, faster version for a 10 to 12 minute video, or a more dramatic version with punchier transitions and more suspense, same facts, different pacing.